All right, well, pull the camera close to you. All right, everyone. So last time I pretty much finished chapter 2. All we do is examples now. This is an example of posting. And posting is you take from the journal and put it in the ledger. This is example of the journal. Everyone, pay attention. In the journal, you got an entry, debit cash and credit capital. If it's debit cash, means business got cash and it came from, it says owner's investment of cash in the business. Owner's investment of cash in the business. You can also maybe zoom in a little bit, right? Just a little bit. So, this is the journal. It says general journal. Now you have to do posting. To post means to copy from the journal to the ledger. You got two accounts. You take the cash account, and the cash account is 101. You take the 101 and you put it in the general ledger. And you copy the same, 15,000, 15,000. Here, you got the debit, the credit, and the balance. In this case, you got the debit and the balance, okay? Balance is the difference between all debits and all credits. That's it. When you do the copy, here you say reference 101, and 101 is this account. For the other one, for the capital, you have reference 306, and 306 in this account. So, when you write the journal, you put in the date, you put in the debit, you put in the credit. Here's the debit amount, number 15,000, the credit 15,000, and you got the reference account, where it is posted. This one post in 101, this one post in 306. And that's the process of posting. That's it. Now here you do the opposite. You got general ledger. You got the same account, you got the explanation, and here reference J1 tells you that it's coming from journal page 1. Okay? That's all there is to it. That's everything. And I continue with some examples. This is an example of a chart of account. It just gives you assets. 100 numbers, liabilities. 200 numbers, equity. 300 numbers, revenue. 400 expenses, 600 and 700s. And all we're doing today is illustration. The theory from last time would just say process illustrated. And the illustration is example number 1. Investment of cash by owner. Cash goes up, capital goes up. Okay? So, basic analysis. As cash increases, owner's equity increases. This is what we did in chapter 1. This is what you just did on your exam. Cash plus 10,000, capital plus 10,000. Cash is a debit account, so debit increases. You say debit cash, and then you say credit capital. Okay? That's the second one. So step 1, basic analysis. Step 2, equation analysis. You already did this. Step number 3, debit and credit analysis. Cash up means debit cash. Capital is an equity, credit capital. So you say cash, debit, cash 10,000, credit capital 10,000. And then you do the posting. Cash, debit 10,000, capital 10,000. That's it. That's all you do. Next one. All of them are like that. Purchase office equipment. Well, they should say whether the purchase of office equipment is on cash or credit, with cash or credit. So, purchases office equipment, by signing note payable. So it's on credit, okay? Note payable. So you say debit or office equipment goes up, note payable goes up. So office equipment plus 5,000, equation, note payable plus 5,000. This means debit office equipment, credit note payable. And there it is. Debit office equipment on the left side, debit 5,000, credit note payable 5,000. And there it is, office equipment, debit. Debit, remember, means left side, credit,
Right side.
note payable. And that's it. Next example. Is it fairly clear? That's it. All the examples are like that. That's everything you do. Receiving cash for future service. Receiving cash for future service. So, cash goes up, and the other one is unearned revenue. So, you have asset, cash up, and the other one is unearned revenue. The asset up becomes debit cash, and this one has to be credit. There's nothing left. Credit, unearned revenue. And it goes cash, debit, 1,200, unearned revenue, credit, 1,200. And then you make the posting, cash, 1,200, unearned revenue, 1,200. Now, just notice that before we had October 10,000. That's the previous one, the investment. Now we're adding one more. We're just adding one more, October 2nd, 1,200. And that's the step. So each step is like that. Next one is payment of monthly rent. When you make a payment of rent, if it's payment, cash goes down, okay? And rent is actually a rent expense. So if cash is down, minus, rent expense comes out of owner's equity. So it could be rent expense or it could be owner's equity. If cash is down, this means you begin with credit cash. Credit cash. And you see here cash is credit. Alright? The debit you always put at the top on the left and the credit is the bottom. So we say credit cash 900 and the debit becomes rent expense 900. That's it. Alright? Rent expense will then go to equity. So you have cash. Copy 10,000 from the last time, 1,200 from the last time, and now you have cash, credit 900, copy, credit 900. That's it. Rent expense is a debit 900. All expenses are usually debit accounts. You just remember that. All revenue is a credit account. And that's the example. Next one. Payment for insurance. Insurance is expense. And so, expense becomes insurance expense. And you have, see, cash minus, no, this is prepaid insurance. Prepaid. Pioneer paid for a 1-year insurance. If it's a 1-year insurance, then it becomes an asset, becomes a prepaid insurance. So if you pay insurance for the month, becomes insurance expense. If you pay insurance for the year, becomes prepaid insurance, okay? So in this particular case, you got cash minus 600 and prepaid insurance plus 600. See the equality sign, minus and plus is 0. So when you have assets, one go down, one goes up. Cash minus 600, it's an asset, so you have credit cash because it's a minus. And this becomes debit prepaid insurance. So you go debit prepaid insurance, 600, and cash credit, 600. Now you copy the cash, and this is from before. 10,000, 1,200, 900, and now this 600, you copy here. These are from the previous three. And prepaid insurance is an asset, all 600. That's it. So you just copy the transaction. We call posting. Next one, purchase of supplies on credit. Supplies are a little tricky. They may be an asset or they may be expense. When we purchase them, we put them as an asset. When we use them up, we consume it, it becomes an expense. So, in this particular case, supplies plus 1,200 because it's on credit liabilities plus 1,200. Supplies an asset goes up, so you say debit supplies, and this one is going up, becomes credit account payable. There it is. Debit advertising supply, credit account payable. The advertising supply debit gets copied here, and the account payable gets copied here. That's it. We move on. An event. Pioneer hires, hiring of employee. Well, when you hire an employee, there is no real transaction. You don't record anything, okay? So, a business transaction has not occurred. This one is easy, nothing. You don't do anything. Next one, withdrawal of cash by owner. That's easy. Cash goes down. So cash goes down, becomes credit cash, okay? And then withdrawal of capital becomes debit. So we'll look at it. Cash, credit. Credit means the right one, okay? And drawing or capital withdrawal, debit. So the cash, now you have this 500 credit, you just copy here. And the withdrawal is a debit. That's it. That's the step. All right. Let's see if we got more or we don't have more. Oh yeah, we got more. Next one is payment of salaries. Again, payment of salary, cash going down. If cash going down, you have credit, cash. And the salary is an expense. So, credit, cash, and salary is an expense becomes salary expense, debit. Take a look. Debit, salary expense, 4,000. Credit, cash, 4,000. This 4,000, we continue. We copy here. Okay? And salary expense, 4,000. This one matches this one. This is a credit, this is a debit. Alright? Let's see if we have more transactions or finished. More transactions. Here, receipt of cash for services provided. Receipt of cash. So, cash goes up. You say debit cash for services provided. If the services provided means that the revenue is earned. It just becomes service revenue. So it will be debit cash, credit service revenue. And we look, debit cash, credit service revenue. The 10,000 cash goes to the debit is this one here. Also notice where you put the debits and the credits, you also add the date so you know what you're copying, okay? You also add October 1, October 2, October 31, October 3, October 4, October 20, October 26. That's it. Service revenue. And that's the transaction. Alright, let's see what else we have. We got an example of, you're going to look at this example over here, and we got a few minutes for, there's a final example that we're going to do. This is just a summary. They just give you a summary. The cash, the investment, that's the first transaction, October 1. Purchase of office equipment. Then you got the cash, the unearned revenue. It's just everything in one big space. It's just the same thing that you do. When you have the exam, you do it like this. Debit, credit, debit, credit, debit, credit, debit, credit. Again, debit, credit, debit, credit, debit, credit, debit, credit, debit, credit. It's the same thing, okay? And then you have the ledger. This is the cash account. And you can see 10,000, 10,000, 1,200, that's the new balance, minus 900, minus 600, minus 500, minus 4,000, and then this is the last revenue. So this is the cash account. This is the accounts payable, the unearned revenue, the capital, the drawing, the revenue, office equipment, note payable, salaries expense, rent expense. And this is what you're expected to do on quiz 2. Analyze, do the debit, do the credit, put the entries inside, okay? And then make the whole ledger. This thing is called general ledger. In general ledger, it's just all accounts, cash, receivable. Everyone, please quiet, okay? We're trying to finish here. I'm just showing you what you're supposed to do, and it's coming on your homework assignment, and later on it's going to be on quiz number 2. That's what you're supposed to do on quiz number 2. And finally, you need to do the last step, or the step before you do the income statement. It's called a trial balance. And a trial balance is simply all the debits and all the credits in the account. So you take all accounts, list the debits, list the credits, and see if they match. Here's what they say. The primary purpose of a trial balance is to prove, meaning to check, that debits equal credits. It just helps you to make sure you did not make a mistake, okay? It helps you to check you don't make a mistake. And this is what a trial balance looks like. Cash is a debit account, so it's got a debit balance, 15. Advertising supplies is a debit account, so it has a debit balance. It's got 2,500. Office equipment, okay, prepaid insurance, debit account, office equipment, debit account, notes payable, credit account, account payable, credit account, unearned revenue, credit account. So you take all the accounts, and for each one you write debit, 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 whatever the balance is from the ledger. And then you add up the debits, you add up the credits, and the total number, 28,700, 28,700. You compare the debit and the credit. If the debit and the credit is the same, this means that you worked correctly. You worked properly. And the final thing, that's the last thing. Out of this, you make a balance sheet, income statement like we did, like you just did on your exam. It's the same thing. Just wanted to show you, for you to start looking at a comprehensive exam. Okay, they give you an exercise here, how it's done. It's a trial balance. And there is one, it's called comprehensive exam, okay? Comprehensive problem. So, this is a comprehensive problem. It tells you September 1, 2, 3, 4, 10, 20, 30. You just go through it on your own. And first you do the general journal. You do debit, credit, debit, credit, debit, credit. You do all the debits and all the credits. That's how it's done. You also have on the side explanation. Then you have the ledger. You do the cash, account payable, capital, drawing, revenue, expense. Here you got the prepaid insurance and so on. So you got the usually debit accounts here. You got on this side the credit accounts, okay? When you do this, it helps to pick the debit accounts and put them on the left. It's just easy for you to think, okay? You don't have to, but it's easy. And it's, you put the credit accounts on the right side. It's just to make things more organized. Then you do the trial balance. You got all the debits, you got all the credits, you add up the numbers, you compare the numbers, that 41,400, 41,400, that the numbers do, and that's it. So next time you do your homework assignments and prepare. We're going to be solving in class these, okay? If you don't have them, don't come to class. And the next time after that, we're going to be solving the problems, okay? So these are quick, easy exercises. They take 2-3 minutes each, okay? And then we're going to do the long, big problems. And after that, you're going to have the quiz number 2, and then the midterm. All right, good enough?
Yeah.
Happy? No. Not good, okay.